The purpose of the Global CFO Council is to provide an educational and networking forum for senior financial executives in order to share best practices, discuss current financial issues, and to learn about current topics related to the performance of their jobs.
The CFO Council, we're global now. Started in Charleston, then the Upstate. Now we've got nearing 1,000 members in the US, Canada, UK, India, Spain, Russia, Japan. And we got folks from all over on this call, Nathan, interested in a U.S. tax update. We have a charity partner, the Educational Foundation for Women in Accounting, the EFWA. They've been around for like 60 years, giving scholarships to women pursuing undergraduate, graduate, PhDs in accounting. And it is almost scholarship time. I think it's like January, they open the portal up. So if you are a woman or know a woman pursuing a degree in accounting, then tell them about efwa.org. And thank you to folks on the call that are serving on the scholarship committee or as mentors to scholarship winners. Special new announcement. We got to spread the word winner from the last meeting. Melissa Salig, CFO of Grove Medical, is the winner and is going to get a box of swag mailed to your house. What is in that box? I don't even know because I haven't done it yet. But it's gonna be awesome. It's gonna be like amazing. So you too could be a spread the word winner if you like, comment, and share my post about this event on LinkedIn. All right, mute Q&A in the chat box, and let's get this started. Nathan, I'm gonna take over the screen. All right, hopefully this works like super smooth like and people don't even notice. All right, can you see what I'm sharing?
I see my picture.
All right, good. Well, I'm kind of giving the advance notice here, but this is for the folks in the chat box to debate if we go beard or no beard, Nathan. All right, beard or no beard, Nathan. I found this picture on the internet, Nathan. I'm thinking beard. I think beard is the improvement. Okay. So I would go with that. And then I'm going to go ahead and start with the punchline here is Nathan has a really strong Twitter feed. He's got the best accounting and tax related gifts in the biz. So if you're on the Twitter tweets, you need to be following Nathan at Nathan P. Clark. Nathan is a tax partner at DHG. Before that, a managing director at BDO. Before that, a manager at Deloitte. Undergrad at Appalachian State, I believe. Is that correct, Nathan?
I would pronounce it Appalachian State, but that's correct.
Whatever. And you are a certified public accountant. Is that true, sir?
Correct.
Do you not have a paper mache deer in your house?
I do. I did not make it.
And I think you are a beer consumer, dog lover, board gamer, and runner. Is that true?
That's true.
Did you run a 50K, which is like 30 miles, for a Patrick Swayze hat?
I did.
And speaking of some of your gifts, you posted a question, and I want to know if you have an answer. Can I deduct other people's BS on my taxes?
You can try.
Okay. All right. I don't know if you're going to cover that in the presentation today. I'll let you take back over the screen while I finish with the last comment. Nathan, impressive list of volunteer activities with the community. There's a really long list of things, both professionally and just for the community, that Nathan is involved in. It made me feel a little guilty, and I need to step up my game. And then, Nathan, you are an active and prolific writer for accounting and tax issues. I feel like if I've read something about taxes, it's probably come from you as a writer or co-written. So clearly a thought leader in this area. I'm personally excited and interested to hear what you got to say. I'm going to shut up, and I'll just hit you with some questions when you get to those Q&A spots, sir.
Okay, sounds good. Thank you for the introduction. That's one of the better ones I've ever gotten. So I guess it's interesting so much is out there on me on the internet, but I am a little bit of a tax Twitter junkie. So I have a lot of connections on Twitter that I use for bouncing ideas off of, just processing legislation, asking people if they've gotten worked through these issues. So I have a lot of great friends out there. So the tax Twitter community is fantastic. Here's an agenda we'll run through today. If you were hoping by the end of this presentation you would know what's going to happen, I will go ahead and tell you you're going to be sorely disappointed. This is just like reading tea leaves. So we're going to do the best to at least read the tea leaves and give you some idea of what might happen. Talk through some of the proposals and as much detail as is provided to us by the Biden administration, what his ideas are around tax reform, and then how likely that is to become law. How could it actually become law? And then if we get to it at the end, there's some sunsetting tax provisions you should be aware of, and then tax planning for the future just under these scenarios. So this is the current standing. I pulled this off the Wall Street Journal Monday, I believe. And so this is just as reported by the Wall Street Journal and the Associated Press. I think thing that everybody's probably paying most attention to is what's happening with these two Senate seats. So you'll see right now the Senate is split 48 Democrat, 50 Republican. There are two runoffs going to happen in the state of Georgia, which will determine those last two Senate seats. Those two are really important because, and we'll get to this a little bit later, but if the Democrats do lose both of those, or if they just lose one of them, they will not have a majority in the Senate, which means their ability to pass legislation or at least influence the debate and the progress of work in the Senate will be out of their control. So I think that's the biggest wild card on this screen right now. So what are some of Biden's tax proposals? At the bottom of all my slides, I've got sources, so you can go check those out. For the most part, it's a couple of articles. There's lots of articles you can go, but a lot of them just regurgitate the same material from the same base sources. So either comes from Joe Biden's website, where he's posted some of his policies, and then from previous campaign speeches he gave or debates where he made comments about tax legislation. Let me move the screen so I can see the slide. So first, on the corporate tax rate, current law is 21% income tax rate. His proposal is to raise that to 28%. And then he's proposed, and this would be a novel creation, and a minimum tax of 15% on U.S. book income. So that's not taxable income, that's your financial statements. That is, if you are in excess of $100 million book income. One question I get a lot about that is, this is the minimum tax. So under the alternative minimum tax, if you pay that tax, you get to use that as a credit in the future to offset regular tax. There's a question I get most frequently is, will there be a tax credit carry forward that you can use in the future to offset regular tax? And there has been no commentary about that so far. Like-kind exchange. So if you remember, before tax reform, you could have like-kind exchange on real property and personal property, and then that eliminated like-kind exchange on personal property. Biden's called for elimination of a lot of tax breaks and benefits that benefit real estate transactions. And so one of those very likely could be the elimination of the like-kind exchange for real property. And then bonus depreciation. This is the ability to expense eligible property upon purchase. Under the tax reform, that was increased to 100%. So eligible property you can deduct outright. There's no limit on the amount of property that you can deduct. And that's scheduled to phase out starting in 2022 through 2025. In 2026, bonus depreciation is scheduled to completely sunset. Biden hasn't spoken specifically about this, but this is likely one of the revenue raisers that he may target in a desire to increase revenue for other spending options. We'll have to continue to follow that one. So this slide covers a number of foreign tax issues. So under current law, U.S. companies for foreign repatriation, they can defer paying the profit on taxes earned overseas until that's brought back to the U.S. What he has proposed is a clawback for any tax benefits or incentives received to a U.S. company that shuts down a U.S. facility and then moves to a foreign facility. And then a new proposal on offshoring. There's not currently any provision to prevent or prohibit offshoring. Biden has proposed a new 10% surtax on corporations that move offshore and then sell goods and services back to the United States. So this one is new. And then lastly, we have GILTI. Currently, this is it applies to shareholder income of foreign corporations, controlled foreign corporations at 10.5%, and you get a deduction in return for that under FDII. He's proposed to increase that tax on GILTI income up to 21%, so that would double it. And then in addition, you wouldn't be able to net country by country on a country by country basis, so you would be on a standalone country basis. So next we've got, this is again, under current law, we don't have a credit for creating jobs in the US, but Biden has proposed a 10% credit if you meet one of these characteristics. So if you expand or revitalize existing or closed facilities, if you retool a facility, or if you expand the manufacturing payroll base, he's proposing a 10% credit for those activities. If you're looking at some of this stuff and wondering, I'd like to have some more detail. You know, what are the mechanics of this? What 10% of what? How does this work? I will tell you, and that's some of the frustration about this. This is just framework right now. It's the intent for what we propose to advance tax legislation on. And so in a little bit, I'll explain a little bit further how that process happens, but I would just tell you if any one of these particular areas is important to you or is very relevant, I would just follow that topic and see how it evolves over the next, months and years. Biden's spoken a lot about fossil fuels and renewable energy, and he's said a number of things, but he wants to curtail the benefits and incentives provided for fossil fuels. So currently, there's accelerated depreciation and depletion, and there are some credits for solar-based products. His plan is to eliminate or minimize all the deductions and incentives geared towards benefiting fossil fuel production, and instead pivot towards more investments that will drive, non-fossil fuel activities. The new markets tax credit's been around for a number of years. This is one of those things that we frequently refer to as an extender. It has a very short shelf life. It's normally funded for 1 or 2 years at a time, at which point Congress decides whether they're going to fund it again or not. Currently, it's funded through 2020 up to $5 billion. There's nothing currently scheduled for the future, but Biden has said he'd expand this and make it permanent. And if you're not familiar, new markets tax credit it's for development in certain zones. So it's not the same, but it's similar to an opportunity zone. If you invest in certain geographic locations, then you're eligible for this credit, and then you have to apply to obtain the credit. So a little bit on the individual side. So current tax rates, the maximum tax rate is 35% through 2025. And then after 2025, it's going to go back to 39.6%. That was one of the revenue raisers of the tax reform bill from a couple of years ago. To make it budget neutral, they needed revenue raisers. And so one of those was a lot of provisions especially those affecting individuals, will expire at the end of 2025. And currently we pay 20% tax rate on long-term capital gains and qualified dividends. So what Biden has proposed is increasing that tax rate back to 39.6%. And if you just think about it, even if he does nothing, the tax rate's going back to 39.6 for individuals in 2026 anyway. So at this point, all he could do is accelerate the way that's going to increase. But he has proposed that only to apply for those with income greater than $400,000. And me as a tax guy, I'm thinking, is that taxable income or is that AGI? Those are adjusted gross income. Those are two different measures on your tax return that things are usually driven off of. So again, no clarity around that. That's just one of my particular questions. And then taxpayers with, again, income over $1 million, capital gains will be taxed as basically ordinary income. The rate will increase on those up to 39.6%. So currently you pay 20% tax rate on capital gains, long-term capital gains. And that's going to, and he's proposed to treat that as ordinary income, just like wages or any other business income. On itemized deduction front, currently you get the choice of whichever is greater, the standard deduction or itemized deductions. And we still have that limit of $10,000 on state and local taxes. That's still there. What Biden has proposed is he's going to restore the P's limitation for those with income greater than $400,000. So, and if you're unfamiliar, the P's limitation is just a haircut on itemized deductions. On certain ones, once you've earned so much money, those itemized deductions just start to get haircut. Another proposal, and this would be a novel proposal, is to cap the value of itemized deductions at 28% for your income greater than $400,000. So currently, if you earn over $400,000, you claim an itemized deduction, it's going to reduce your taxable income that's then taxed at presumably 39.6%. What this is proposing is say, okay, you're going to get the itemized deduction, but not all the way up to 39.6%. You're only going to get it up to 28%. So it's another haircut that's going to be applied to individuals' taxable income. But he has proposed removing the SALT cap, the $10,000 limit on state and local taxes. On the individual tax credit front, currently we have a $2,000 child tax credit. $1,400 of that is refundable, but it is subject to phase out. So once you start earning so much income, the refundability of that credit phases out. Biden's proposed several new credits. First, he's proposed a credit to make health insurance more affordable. The child tax credit, and we currently have that. He's proposed to make it more generous. And then lastly, he's proposed another credit that would provide $15,000 credit towards a first-time home buyer's purchase. On the estate tax, currently the tax rate is 40%. And there's a basic exemption of $10 million, so you can exclude $10 million of estate from this 40% tax rate. And when you inherit assets from an estate, your basis in those assets is stepped up to fair market value. On both of these points, Biden has proposed increasing that estate tax rate from 40 to 45%, which is the level from 2009. And reducing that exemption amount from $10 million down to $3.5 million. So many more estates would then be subject to the estate tax. And he's also proposed the repeal of the stepped up basis at death. So if you inherited Apple stock from somebody with basis of, $2 when it was really old, and now it's stepped up. Well, what's Apple's basis now? What's their fair market value of Apple stock now? I don't know, but it's a lot. You're not going to get that step up. You're going to retain your grandmother's basis from $2 from whenever she bought it so many years ago. So that's the difference there. That would be a big loss as well for individuals. receiving assets from inheritances. And then lastly, on the payroll tax, I think this is the last of my provisions here. So currently you pay Social Security, and this is split between employer and employee, of 12.4% up to 137,700. And then beyond that, you do not pay any Social Security tax. In addition, you pay Medicare tax. Again, that's 2.9%. That's split between employer and employee, but no limit. On the Social Security piece of that, Biden has proposed that, well, no change up to 137,000 of income. And then once those wages cross $400,000, you're going to start paying Social Security tax again on your wages in excess of $400,000. So there's kind of this donut scenario where you won't pay Social Security for a while, and then once your income is over 400, you'll start to pay Social Security again. So that's the end of these provisions. I don't know if, Robert, there were any questions that came through?
There were a bunch.
Oh,
And
good. All right.
I feel like this whole presentation thus far has just been triggering me. My pulse is up, my hands are sweating, but I'll keep my opinions to myself.
All right.
I got a couple of 10,000 foot kind of high level questions and then some detailed ones. To start first, Nathan, it is a clear 100% beard versus no beard. So
Glad to hear that since I'm wearing the beard right now.
yeah, we have full alignment with at least one issue today. First question is just at the macro level. I believe the Trump tax cut was something like 1.5 trillion. Do you have a sense of what, if all this theoretical stuff passed, what we're talking about in comparison at, that 100,000 foot level?
I do not, and I'm not certain that there's any guidance or any published material out there on that. I will prefer people to, if you want more details on these, because this is the source I would go to, the Tax Foundation, which I've got two sources. One is the Tax Foundation. The other is the Tax Policy Center. One leans a little left, one leans a little right, but they're both very reputable tax think tanks. They both have a lot of analyses on these, and if that kind of projections are available, one of those two would have it.
Next question was the tax-related Trump executive orders, do they automatically cease after office, or does it take another act of Congress or the Oval Office to change an existing executive order?
To be honest, I'm not exactly sure. I believe executive orders remain in effect until they're removed. So I believe Biden would have to undo it, but I'm not certain. And
Nathan, any idea on how there was a slide on an offshore tax, and how the Biden administration would know if it's offshoring and it should be taxed, or if it was just an expansion of production overseas for a global company?
Yeah, those are the kind of details that we don't know yet. And I can tell you with FDII, there are record-keeping requirements. So if you're going to claim FDII, which is the deduction under GILTI, you've got to be able to document that you are selling products outside the United States to claim the credit or to claim the deduction. So I would expect there probably would be some record-keeping component of that, but we'll have to wait until we see legislative text.
The numbers that you mentioned, Nathan, about income and tax at this level, were those at the individual or married filing jointly buckets?
It didn't specify, so I do not know.
And any of these potential tax changes impact 401k deduction benefits for any employees or lower income workers? Up or down?
There hasn't been any commentary on how this would affect income levels lower than 400. Biden has been very clear in all of his campaign speeches that he wouldn't raise taxes on those earning less than $400,000. So I wouldn't expect to see any change there, but you never know until the text is written, the law is written.
And last question for this segment, and I'll hold and give you, but is just a personal one for me, is around the new market credit. I remember reading some articles. I think Senator Scott of South Carolina was involved in some part of the new market tax credits. And could you speak a little bit more about, you said those likely should stay intact. Any idea that they might expand, or are they fully funded? Any more information on the new market tax credits?
We'll have to monitor legislation as it comes out. That was one of Biden's proposals, was that he would make the new markets tax credit permanent. But beyond that, we don't know at what funding levels or any of those kinds of details. At this point, we have to wait until we have a law to see how it's written.
Nathan, I got a bunch more questions, but I'm going to hold them to the next break.
All right, sounds good. So the next we want to talk about, what will become law? And I think what's probably important to know, in this process, you get these initial proposals, which are just really like outline form. If you go look at Biden's webpage, the details of these proposals, there is no more detail than I've given you today. It's just, we're going to expand this credit. We're going to eliminate this deduction. We're going to focus on these specific areas. And the next process with that is where I really start paying attention. There are two committees, the Senate Finance Committee and the House Ways and Means Committee. Both of those committees are the ones that actually produce the legislative text that would eventually become law. So I don't really get too excited until I see something come out of those. And then they may start to release draft legislative text. Then you can start to see, how are they expanding the new markets tax credits? Or how are they applying these $400,000 phase-ins and phase-outs? Is that married? Is that joint? Or is that single? That's where you would start to see, all right, this is the initial proposal. And those committees will vote them to come out of committee. And they do this independently too. And then the House would have to approve that draft. And then the Senate would have to approve their draft. And then they have to marry the two together and reconcile them into a single law. So that's kind of the process this goes through. Let me advance my slides here. Here we go. So how does the sausage get made? How does this become law? So there are two scenarios we got to think about. The first is if we have a divided government. And so that comes back to if it's not all Democrat controlled. So presumably Democrat in the White House, House controlled by Democrats. But if either of the Georgia Senate seats are lost by Democrats and they go Republican, we're going to have divided government, which means Senate will be controlled by Republicans. So for any legislation to get passed, it's going to have bipartisan agreement. And so what you're going to look for is what bills are likely to pass, what could into law, and then look for amendments to get tagged along to those. It's unlikely under divided government that we see big, massive tax legislation. It seems unlikely to me that any Republican is going to vote for a tax rate increase for corporations, for individuals, for many of these other things. And so that's what you've got to have. And so if you don't have that compromise, if you don't have bipartisan agreement, nothing's going to happen. And so the last thing, the reconciliation process, I'll cover that more in a minute. Under Democratic control, so this assumes both of those Georgia seats go Democrat. So that would make the Senate split 50-50. Kamala Harris would cast the 51st vote, giving Democrats control of the Senate. Well, if you want to pass a law through the Senate, it's got to have a simple majority, 51 votes. So they would have the 51 votes, but the filibuster still exists. And the filibuster the minority can use it to prevent debate on a bill from closing, which would prevent vote on a bill. So in that particular case, the Republicans still could limit the amount of legislation that actually hits the floor and then becomes law. So the back door around the filibuster is this reconciliation process. It's how the Affordable Care Act was passed, and it was also how the Tax Cuts and Jobs Act, the tax reform law, was passed. It was done through a reconciliation process, which means it's a funding bill, and it must be budget neutral over a 10-year window. And there's a process that you can go through, that the Senate would go through to use the reconciliation process. But to do that, the benefit is it cannot be filibustered. So they can work, and so that's how the Affordable Care Act and Tax Cuts and Jobs Act became law, was they went through this reconciliation process. But one of the trade-offs with that is it must be budget neutral over a 10-year window. And so you start scratching your head, well, why is this tax reform law so complicated? Why do we have all these individual provisions sunsetting? Why do we have why is bonus depreciation sunsetting? They needed revenue raisers so it would be budget neutral at a 10-year window. So that's why some of these things are bleeding off over time, so that at the end of this 10-year window, it's budget neutral. So that's really what to pay attention for. In divided government, you're going to have bipartisanship agreement. Under a Democrat-controlled government, it's very likely you could see something go through this reconciliation process. So where could we see some amendments? The next one coming up is December 11th. The government will run out of funding at that point. And Mitch McConnell and Speaker Pelosi have both said they do not want to have another continuing resolution, which is what their government is currently funded other, which funds the government at last year's levels. So no increase in any programs. So they've both proposed funding the government, and that bill, the government runs out, that funding, that CR runs out on December 11th. So when that passes, pay very close attention if it passes. Were any tax laws attached to it? Again, President Trump will still be President Trump at that point, so it's unlikely that he's going to pass anything that would unwind any of his tax legislation so far. There seems to be renewed interest, and there's more discussion in the past week around COVID relief and economic stimulus. So bipartisanship there, look for things to attach to that. That may happen in the next couple of weeks. It may not. But if Biden is president by the time the next round of COVID relief passes, you very well could see some of these items make it into that law. Every year there are tax extenders, and I've got a slide coming up on some of the more relevant ones in the next couple of years. But people don't like to see those extenders pass because very often they look like tax increases. So you may see legislation to extend these tax provisions, and that could come. So just pay attention when they start talking about those. Just watch for that. And then lastly, during the campaigns, there was a decent amount of discussion around infrastructure, and I think there's probably some bipartisan support for that. So if an infrastructure bill gets passed, look for some tax legislation maybe to get amended onto that. A couple of things that start to influence the conversation as debate happens over passing law. You're going to hear conversation about record government debt, significant deficits, sunsetting tax reforms. I think all of those things are going to influence the discussion. And the minority party tends to bring them up as, you know, the tool to push back on government spending and deficits. So expect to hear more about, you know, curtailing debt. And then I don't think we're scheduled for, I don't know the exact date for another debt ceiling increase, but if you remember a few years ago, or I don't think it was even a year ago, a number of months ago, the debt ceilings ended up being kind of a hostage situation to controlling government spending. there's some question, and the last debt ceiling was pushed far enough out to get past the presidential and other elections. So that was done intentionally so it wouldn't have to be dealt with during the election cycle. But when that comes back around, will we see more of the using the debt ceiling as a tool to constrain government spending? So these are, I think, are all things that are going to influence the conversation around what tax reform, well, excuse me, what tax laws could get passed. I'll pause there. Robert, I don't know if you got any more questions.
I do. First one is from a few slides ago, just it was absent. Any thoughts on the individual mandate to buy health insurance, if that'll be required again? The Supreme Court called that a part of the U.S. taxing power.
That is uncertain. And the Supreme Court, I don't think, is scheduled to rule on that law until June of next year. But there were some hearings a month or two ago. I forget exactly when that was, but my own personal armchair quarterbacking, listening to that, was it didn't sound like from the comments that the justices were making that they were likely to strike down the whole of the Affordable Care Act. But again, if I were smart enough, I'd be a Supreme Court justice too, but I'm not there. But, and I do know that my firm has been paying particular attention to that, because if it is ultimately struck down and we don't get that law until June of next year, some people have been paying these taxes. And so there was some question about, well, if this law is struck down, then we have clients and businesses that paid this tax that's now deemed unconstitutional. We want that money refunded. So we have been paying close attention to that, and advising our clients on what they should be doing, if anything needs to be done at the moment. But currently we're waiting to see how the Supreme Court rules.
Next question is on and I forget the acronym, but it's the state and local tax. Maybe that's SALT. That was dumb.
I think so.
Sorry. There's a little disconnect between there. The rest of the tax policy seems to all be high income earners tax increases, but the cap on the state and local tax deduction, a change to that would benefit high income earners in states like New York and California the most. Any thoughts on the likelihood of that passing and why that divergence in the rest of the policies?
I think the divergence is all politics, because the states primarily affected the most are very blue states politically. It's California, New York, New Jersey, the Northeast, where people pay lots of taxes. And so it's a benefit, it's a tax provision that benefits a lot of Democrats. So in that particular case, it's politics. What was the other part of that question?
Just that you answered it.
Okay, all right. I thought it was a two-parter there.
Next, this is kind of a legislation question. I don't think anybody really knows this, but when you hear things like, oh, the Democrats, if they gain control, they might change the filibuster, or they might give D.C. and Puerto Rico state status so there's more senators. Do you think that's talk, or do you think that could possibly happen?
It seems like a lot of talk, and it's definitely talk of its divided government. But if it seems like there's some political will there. Whether they have the politics to make it happen, I just don't know. Like, for example, if you've got to have a simple majority in the Senate to add Puerto Rico and D.C. as states, couldn't the Republicans just filibuster that? That's a question I have, and I don't know the mechanics of how that works.
And then there doesn't seem to be anybody talking about paying down the debt. You had some really great slides there, emphasizing the amount of debt, and nobody seems to be talking that. But while you were talking, I looked it up. I think like something like 10% of all taxes collected by the U.S. government is paid it just to cover the interest. Is that part of anybody's conversation that we have $27 trillion worth of federal debt?
I think Rand Paul seems to be the only person that talks about deficits and debt limits. But I at some point it's going to come back around. I mean, just as an accountant who likes to see things balanced, that much debt's got to balance at some point. That's got to come due at some point. And I again, above and beyond my pay grade, but we'll have to wait and see.
Because we're accountants, that just so everybody knows, when you're doing your own personal financial statement and figuring out your assets and liabilities, that translates to $82,000 per citizen. But guess what? Not all citizens pay taxes. That's $220,000 per taxpayer, like the folks on this call. So be frugal, folks. They might be coming for us.
I was watching another presentation, and they were talking about the stimulus, the economic stimulus that was passed earlier this year. Like, I think the CARES Act was $1.4 trillion or something. And if you took every dollar, and if that equated to 1 second, how much time would that equal? And it was thousands of years. So if every dollar was a second, that would, the amount of time it would take, if you paid $1 per second, it would be thousands of years before that's fully paid back.
Yeah, I think that it's much better when we talk about debt to anybody. You got to talk about it, divide it by person, because that's just more manageable logically. 27 trillion is might as well be a gazillion. It's just an imaginary number. But I think when you say that's $220,000 per taxpayer, it's like, what?
That's your share. Yep, that's a good way to frame it.
All right, I'm getting triggered again. I'm gonna mute myself. Nathan, please proceed.
All right, sounds good. So sunsetting tax provisions, down in the bottom right of this slide is the source of this. And the Joint Committee on Taxation, which is a government organization, publishes this annually. And they publish a lot of great material. But they publish annually a list of all the expiring tax provisions and when they expire. I've pulled out some of the bigger ticket items, and I'm not going to talk about all these, but a couple of these I do want to point out. So the first one, currently your R&D expenditures are deductible. Starting 2021, or those R&D expenditures. So next year, you're going to have to begin capitalizing and amortizing over 5 years your R&D spend. To be quite honest, most people look at this as a real head scratcher. R&D is assumed and believed, everyone, I don't think anybody disagrees, is a driver of our economy and of innovation. Why would we make R&D more expensive? So I think this is something that could very easily get repealed. Bonus depreciation is going to phase out completely. So right now it's 100%, and then it's going to start to step down in 2022. It'll drop 20%, and then 20% the next year, and 20% the next year until it's fully gone by 2026. There's a few other phase outs. 163J, which is the interest expense limitation. The 5-year NOL carryback, that's only available for 2020. And then the last bullet, one of the interest expense limitations, one of the big changes, which will start 2021, is currently when you're computing your limitation, you can claim the benefit of amortization and depreciation. After this point, you're no longer going to be able to have the benefit of depreciation and amortization when you're calculating the limit of your deductible interest. So it's very likely when that goes into effect, you could start to, more businesses will start to see their interest expense deduction limited. So just a few points on tax planning for businesses, because a lot of our clients, they ask us, with all of this stuff, what can we be doing? So first, I mentioned the NOL carryback for 2020. So if you paid taxes in a prior year and in the prior 5 years, you can go back and claim the losses in 2020. So if your business is generating losses, tax losses in 2020, you can carry them back as far as 2015. And if you calculate your provision for income taxes and your effective tax rate for financial accounting purposes, if you think about it, this creates a permanent tax savings where I can take a deduction this year and claim it against tax rates from 2015, which were at higher tax rates. So you can get a permanent tax savings from that. The employee retention credit, this was one of the things introduced by the CARES Act. So if a business was either they saw substantial reduction in gross revenue compared to the prior year, compared to 2019, then it's an eligible business. Or if you have a government order that affected how you do business, then you may be eligible for the retention credit. And that's if you paid wages or health insurance benefits for employees while they were not working. And to some degree, it's very flexible. So it doesn't necessarily mean that, well, the employee's not working at all, then they're not eligible. If employees maybe cut their shift back from full time to say 6 hours a day, and you're still paying them at a full rate, well, that 2 extra hours, you could claim a retention credit on that. And the maximum credit is up to $5,000 per individual, no limit. But it's based on the amount of wages you pay an employee. What we see with many clients is they have furloughed employees for a period of time, and the insurance component. So you on furlough, many businesses on furlough, you're not paying your employees a wage, but you continue to pay their health insurance. We saw that quite frequently. Well, that health insurance is eligible for the retention credit. So again, this applies to eligible employees and during a period where you are an eligible business for the credit. And that's a credit. It's not an income tax credit. It's a credit against payroll tax. So whatever your payroll tax liability is, you just reduce that amount you have to submit to the government. If it happens to exceed the amount of the liability for a quarter, then it becomes refundable. So if you are looking at this slide deck and you're thinking, the sky is falling, tax rates are going to increase, how do I plan for that? Well, I'm paying tax at a very low rate now. And if I expect that I'll pay tax at a higher rate in the future, how do we do that? Well, let's instead of accelerating deductions now to this low tax rate period, let's defer them to the future and claim the deductions in the future rather than now at higher tax rates. Likewise, I want to accelerate revenue to 2020, pay it at the lower rate, because if I wait and pay the tax on that revenue in the future, then it'd be at a higher rate. And so the way we do this is through changing your tax accounting methods. You can shift between them and change the timing of when you recognize income and deductions. Something else to think about, a distressed economy creates a lot of weird situations, things you don't normally see. You may see clients or customers start to slow pay. You may see customers going into default or bankruptcy, or just refusing to pay. So are there bad debts that you could identify and claim a deduction now for tax purposes? And for tax purposes, you can't claim a reserve. You can only claim a bad debt deduction when it actually goes bad. So a lot of businesses typically don't pay that close attention to their bad debts. They just, whenever they write off the AR, then they'll claim the deduction. But can you accelerate that deduction? I've also seen a lot of weird things around inventory. So do you have obsolete inventory? Can you accelerate those deductions? Do you have revenue disputes with customers? And then do you have worthless assets? Either assets that can be disposed that you're no longer using, securities or intangibles, stocks that are just worthless now, or intangibles you acquired that you're no longer using. So these are just some of the options to look at. That's just high level, some things to be thinking about when you look at this. That's the end of the slides, end of the material I have, but I can entertain some more questions if we have any, Robert.
Yep, I got a couple I'm going to hit you rapid fire with. One is, you mentioned R&D expenditures and capitalization and amortization. How does that impact, or is there any known impact to the R&D tax credits?
It doesn't affect the credit, so you can still claim the credit, but you just have to, you can't claim a deduction for those expenses any longer. You have to, and it's regardless of whether you claim the credit or not. Your R&D spend has to be capitalized and amortized.
To the corporate tax planning, if you have a high accrued tax liability, any macro recommendations for corporations?
So my background is tax accounting methods. That's what I spend most of my day doing. And accrued expenses are, there are lots of opportunities for tax purposes to claim a deduction for an accrued expense, but there's a lot of rules around what you can deduct and when. So it really depends on what the item is. Is it compensation? Is it bonus? Is it services? It can be a wide variety of things, and the deductibility really depends on what the particular item is. And so there's a lot of, and when I say a lot, that's in all caps, a lot of special rules about determining when an accrued expense is deductible for tax purposes.
What's the latest on PPP loans and taxability?
I'm not the most well versed, or I told someone this morning, I'm not on the cutting edge of PPP, but right now the general thinking is that if those expenses are not deductible, and it likely would be if you receive, or you reasonably expect to receive, loan forgiveness. So there's a lot of speculation about, well, Congress intent, and can we deduct them under Congress intent and things like that. But my understanding is that it's going to require a legislative fix for those expenses to be deductible, unless the loan just isn't forgiven. But then it may be a matter of timing. You may not get the deduction until you actually choose. I mean, if you choose to decide now, I'm not going to apply for forgiveness, then I think there's an argument to say those expenses are deductible.
Have you heard anything about a change to the tax deductibility of 401ks for some people?
I have not.
Any thought of changing capital gains tax structure for non-residents, say a foreign national like a Canadian that owns real estate in the U.S.? Is that popped up in anybody's plan?
No, not based on anything that I've read. It's still very high level.
Well, Nathan, we have hit you with broad questions, and we got narrow on some of these questions. You did a fantastic job, and I personally really enjoyed the presentation. There's a lot of unknowns. I think you've given us a foundation of some things we need to follow and need to keep an eye out for as more information is known. Right now, you said it best. There's just a lot unknown, a lot of potential. And I'm going to plug you, Nathan. You, as I said at the beginning, are a prolific writer on all these tax policies. And DHG has a great content section on their website. You can follow Nathan on Twitter if you want to have some fun. What did you call it? There's a tax Twitter community?
Tax Twitter.
Oh my God, that sounds so exciting. I might have to get on the Twitter tweet just to follow that. Oh my gosh.
It's a bunch of tax nerds. So
yeah,
most of my family and friends don't follow me on Twitter anymore because it's just 90% tax stuff, 10% stupid gifts.
Well, I think all this just, as a certified public accountant, I feel like every administration with all these crazy potential new rules, really what it is, it's the CPA Full Employment Act
Absolutely.
I just feel like us and trust and tax attorneys just have a job forever. It's the greatest thing I ever did. I just shake my head. Every administration just make sure I have a job forever.
I, I don't really care what the tax law is as long as I keep changing it.
Well, thank you so much, Nathan, and I really appreciate this. DHG is a really amazing firm, and you've been excellent. Appreciate DHG's partnership with the CFO Council. And folks, I don't ask much, okay? But I do ask that you like, comment, and share my content on LinkedIn. It's the one thing I'm on, and it's a great way to say thank you to the speaker. And tell him how awesome his beard is, okay? That's all you got to do. It's one finger, and you could win an awesome swag bag like Melissa, the CFO of Grove Medical. You could be the next person to receive an awesome swag bag from me. And all you got to do is click like and comment and share. That's it. Thank you, Nathan. Goodbye, everyone.
Thank you, Robert. Thank you, everyone.